Tesla stock is down 66% today. Just kidding. So the reason I would put that in the title is I wanted to have an absolute clickbait. And the reason being is everyone confuses a stock split with a stock being cheaper. It is not cheaper. I'm going to repeat till I'm blue in the face. A stock split does not make the stock cheaper. It makes the price per share lower. But here's what actually happens. If a company has 10 shares outstanding and each share is $30, okay, what's the market cap? $300. Very simple, right? If they do a stock split, a 3-for-1 stock split like Tesla did, what they're doing is they're now taking the 10 shares to 30 shares. But they're not taking the price of the stock down 1/3. What's the market cap? It's the same market cap. Please don't fall for this, being that the stock is too expensive. That is not what that means. But companies do this in order to get more people buying more shares because they know people like to say, I own 10 shares, I own 30 shares of something versus 10. I own 300 versus 100. It makes people feel wealthier. You're not actually wealthier. You have the exact same net worth on that one. The company is still a $300 company. That's very simple. So where does Tesla stand today? Well, what I want to do here is, if you're new to this channel, I'm Paul. I'm a value investor. I look at the quantitative aspects of a business to determine if I want to do more research and then eventually buy the company. Now, Tesla is a phenomenal car company. We all love it. I ordered one. Mo has one. Seth has had two. It is a very popular car. They've done a great job. I believe they're the #1 manufacturer of electric vehicles in the world. So the question becomes, if you believe that, do you buy the company? No. That doesn't mean you automatically buy the company. There's a difference between stock price and company. You need to be able to separate the two. It is possible to overpay for a great company. In fact, a lot of the times that's what happens because a lot of people love the company, et cetera, et cetera. So my job is to look at the quantitative parts of the business. And as a value investor, my goal is to buy the company when I think it's selling for less than I actually think it's worth. So let's go use our software and look at the company. So if you have our software, please follow along. And if you don't have our software, you're going to love it. Watch our other videos. So the stock is pretty much even today because it's split 3-for-1, but it's pretty much even. Okay. And as you can tell, guys, the chart's exactly the same because it was just a stock split. Everything gets tripled or cut by 1/3. That's all that happens. That is it. The market cap is the same as it was yesterday. The exact same. That's it. So let's take a quick look. They pay no dividend, but look at this interesting stuff. Look at this free cash flow last year, $7 billion, which is way better than their 5-year average of $1.56 billion, which includes that. Not a high return on invested capital, but that doesn't worry me so much because they spent a lot of money reinvesting in the company. Free cash flow is cash from operations less your capital expenditures, right? So when they're spending a lot of money investing in the capital expenditures, they're going to drive down their free cash flow. And I calculate my return on invested capital using free cash flow. Now, some alarming things. 5-year PE, 527. 1-year PE, 96. That's already kind of a, oops, let's see what happens here. It's really hard for such a big company to have such a high PE. Because remember, every investment is the present value of all future cash flow or earnings, whatever it is. And in order to justify such a high PE, you got to have a lot of future potential profit. But you're already $1 trillion company. So that's automatically a red flag for me. They did $67 billion in the last year in revenue, and they had net income of $9.5 billion. Now look at this. Their 5-year profit margin is 5%, and last year they did 14%. So whenever I see that, I go, why is there such a big difference from last year to this year? Well, for one thing, they're raising their price a ton on cars. It's really going to drive up a lot of their profit because they could, because the demand was huge for their cars. I bought a Tesla Model X, and I owned it for 2 days. I didn't like it, not for any other reason than it just wasn't for me, but it's a beautiful car. It was super fast and awesome. And I sold it in 2 days and sold it for $20,000 more than I paid for it, including taxes. So the demand was there. Tesla did a great job with that and capitalizing on that demand. So let's go check out our 8-pillar tab right here to see more about the company. So a lot of X's here. 5-year PE, 527, 5-year price to free cash flow, 585. Obviously, they have revenue, profit, and free cash flow growth. Now, X here. The 5.77 is our long-term liabilities divided by 5-year free cash flow to determine if the company has too much debt or not. Guys, remember, like I said, the free cash flow I'm not worried about because they're still a growing company, but I'm not worried about this number being an X. The things that do concern me here are just these. I can accept everything else because of the growth of the company. They're going to sell 1 million cars this year, but I do believe this is a company that eventually will sell 4 to 10 million cars. How much? I don't know. But people think that just because they got to 1 million cars, it means they're going to go to 10 million. I have no idea. But my job is to make assumptions about the future and determine what to pay for the company today based on those assumptions. So let's go check out a couple other things real quick. Their cash flow statement. Remember, free cash flow is cash from operations less their capital expenditures. Look at their cash from operations, skyrocketing. Negative, slightly positive, negative, 2.85, 2.7, 9, 14 billion. I mean, they're just skyrocketing. But the last year has been very, very good for the auto industry. It was very tough. I mean, right now, you got to go out there, you're not negotiating for a car. You're paying sticker. And you're okay with that. Why? Because that's just what you do. Because the supply of cars is very low. But that's not going to stay forever. That's not going to stay forever. It's eventually going to calm down. So just like housing, and my videos on housing previously, it's hard to sustain that for a long period of time. Is that going to continue? Now, the good thing for Tesla is it's not like they sell 10 million cars a year where they don't have the upside potential. They can still grow their revenue and profit just by their natural growth rate. So let's go see what that is. So guys, here's what we did. We have a thing called the stock analyzer tool. So on this software that we have a whole bunch of tools, the community chat where everybody's talking about Tesla and everything like that. But we created this stock analyzer tool. What it does is it allows me to make assumptions about the future because I don't know the future. So I make assumptions on revenue growth, profit margin, and free cash flow margin, and then a future PE and price to free cash flow. And then I put in my desired annual return, and it gives me a price to pay for the company. Now, why do I do this? Well, I don't know the future, but I'm going to make reasonable assumptions. And if the stock is selling for below those reasonable assumptions, I'm probably going to do more research to make sure I'm a buyer. What are the things I'm going to research here is supplies, supply chain. Are they getting out of their supply chain issue? Pricing for Tesla. Are they going to continue with these high prices, or is that just a fluke because of where the car industry has been in the last year? I don't know, but these are the things to go look at. Great place to start is our community. For less than a cup of coffee per day, you guys can get all of this. Go to everythingmoney.com. I'm not going to give you the spiel right now, but it's such a no-brainer to get in the community and start talking about investments. So as I do the stock analyzer tool, I really encourage you to watch it a few times over and over so you can really understand how I'm assessing the company. So the first thing first, revenue growth. Guys, look at these 10-year, 5-year, and 1-year revenue growth. This is not sustainable. The company did $67 billion in the last year. If they did 50% a year in growth for the next 10 years again, to the 10th power, they would do $3.9 trillion in revenue. Spoiler alert, that ain't going to happen, okay? So just remember that going forward. $3.9 trillion, considering Amazon now does $500 or $600 billion a year, and the entire U.S. economy is 20-some trillion dollars a year, this company would be 20% of the U.S. economy. It ain't going to happen. So what are my revenue growth numbers? Well, let's say they do 1 million cars now, and in 10 years, the high side, they do 10 million cars, which is a really high. That's a 10 factor over the next 10 years. That's 25% growth rate. I'm going to put that as my high level. Is it possible? Sure. Is it probable? Absolutely not. That's the point here. But I want to put on the high side there just to show about the high end levels. Now, what's a reasonable assumption for where they're going to be in 10 years? Let's call it 4 million cars. So they did 1 million cars last year. 4 million, they're going to do 1 million cars this year, 4 million in the future over 10 years. That's a 4 factor over a 10-year period. That's 15% per year. And let's assume they just do 7% a year along the way on the low end, okay? Because I think they could do a few million cars a year in the next 10 years, very reasonably. All right, profit margin. Now, they are still a car company. So as much as you want to say they're a software business, they're not. They're a car company. And car companies don't have good margin. It's just a matter of time before unions get involved. And all of a sudden, before you know it, their cost structure is going to be much higher. So I'm going to go 4, 6, and 8%, even though last year they did 14%. But like I said, I thought last year was a fluke. Could I be wrong? Absolutely. But I think last year was a fluke. And I still think 8% is a very healthy margin for a car company. Now, in terms of free cash flow, I'm actually going to do the exact same thing because over long periods of time, free cash flow and earnings should be very similar. Now, PE. So this is the big one, guys. Their current PE is 97. Their 5-year PE is 580. Their current price to free cash flow is 133. So a lot of people who might run for governor in California will sit there and say a reasonable PE for Tesla is 70. No, it's not. The average PE over long periods of time is 15. And the bigger and bigger a company grows, the slower the growth rate will be. And there are two major factors to me on what determines PE: moat and growth rate. I do think Tesla's creating its own moat. It has the Tesla fanboys. Everybody loves it. But just remember, in the 90s, Dell Computer had major Dell fanboys. And look what happened. Now Dell is not the same fanboy business. So just remember that. But I'm going to be a little more aggressive. I'm going to go 14, 17, and 20. I don't think 20 is reasonable for a company that does 10 million cars a year after their high side. But we're still going to put it in there. And for desired annual return, guys, I'm going to go 15%. The reason being is there's a lot of fluctuation here and a lot of unknowns here. And also, as much as I love Elon Musk, he's still doing random things here and there. He's still involved in multiple businesses, all these different things. I get a little concerned about that. So I want a pretty good return on my money at 15%. So I'm going to hit the analyze button. Down below, we're going to have 6 prices. We're going to have a low, middle, and high on earnings and a low, middle, and high on free cash flow. If it's all green, that doesn't mean go out there and buy. It means go verify these numbers are legit. How do you do that? Go do more research. Go sit there and see what their earnings calls are saying. What do they see for the future? What are their issues coming up? What are their margins coming up? Have a conversation in the community. This might sound generic, but that's the point of it. Go in there and do what Philip Fisher calls scuttlebutt. Go out there and see what the bulls and the bears are saying about Tesla. You can see articles all over the place. You can have conversations in here. We have Tesla fanboys in here. We have Tesla haters in here. It's a good way. Go spend the 1 cup of coffee a day to get in the community and talk about that. So I'm hitting the analyze button. Scroll down below. Oh boy. A low price of 10, a high price of 100, and a middle price of 30. So if this scares you, don't be scared. Go look at history. I do agree with these pricings. I actually think it's more along the lines of $30 to $40 a share after the split, but I appreciate watching this video. If you're interested in this, want to learn more about margin of safety, watch our next video on our margin of safety and why it's so important in investing. And please don't forget to subscribe to our channel. Thank you very much for your time.